things are going to get hotter in the economy, and the Fed's still going to be there. So could this be the best of times for the market, Guy?
Yeah, it's an interesting. First of all, now I have, what do they call those things? An ear tick, when you get a song in your head that you can't get out. They rick-rolled. You just basically rick-rolled the entire United States and maybe parts unknown as well. I don't know how far the Fast Money show goes, but I'll say this. You might think the Fed has your back. The Fed doesn't have your back. The Fed has our back the same way the neighborhood bookie used to have the back of the guy betting the Monday Night Football game. It's folly to think that. Now, I understand the market believes that right now, and I get some of the exuberance that we're seeing, but I think it's just I think it's misguided to think that somehow the Fed is going to guide us through this and sort of thread the needle to the other side. I just don't think it's happening. And oh, by the way, I don't know who Katie is, and I'm not sure why she had to bar the door. But if the TLT goes through 135 on the downside, look out, folks.
Katie barred the door. Karen, what do you think in terms of the temperature of the market, the environment right now? Because right now everything holds promise, holds hope, and we know that the Fed is going to do their most to keep interest rates as low as they can.
Right. That is true. There's so many good things to point to, right? The reopened trade and the stimulus package and the vaccines making their way through the population and the reopened trade really strong. All of that. But I feel like we seem to be up every day the last few days on that exact same news, right? The stimulus has been happening for a while in slow motion. You could have seen it coming. The reopened trade has been happening in slow motion for a while. I mean, I just sort of contrast that with last year, a year ago, next week or so. Obviously, the market was terrible. If I had said this pandemic is so much worse than we think, we're going to shut down, every state's going to end up shutting down, you wouldn't have said this is a great time to buy, which makes me think, wow, everything does seem great now. Maybe it's not a great time to buy now, right? I can't help but think the risk reward is skewed. All that having been said, I'm always long. I never try to time the market because I'm sure that I would be terrible at it, but it does feel very frothy.
Not that claims ever are market moving, but today claims were at a 4-month low. We got CPI data earlier this week, basically saying inflation remains in check, which is a big concern of the markets, Tim. So where do you stand here? It's hard. I understand the concern that Guy states. I understand the concern that Karen has, even though she is still long. But it's hard to argue against this force here.
Well, first of all, we have to have a little trade school because people get very concerned when they get rickrolled. And so for folks across America, this is when someone sends you a text that says, hey, check out this picture of my dog. It's so cute. And you click on the link and it's Rick Astley singing this fantastic song that's now stuck in all of our heads for the rest of the day. So there's your trade school on being rickrolled. As far as the Fed, is the Fed rickrolling us or is the Fed got our back? Look, I don't think it's either. I think clearly with Janet Yellen now in the Treasury chair and Jerome Powell and Janet believing the same thing, we've gotten a double dose of monetary policy meets fiscal policy. Right now, very good news. The Fed also has told you, as in those CPI numbers, that inflation is transient and that this is a dynamic that, if anything, they're going to let, the symmetry on the side of overshooting is also the market's friend. So what I worry about is when the Fed is going to give us any indication of when they have to reverse field. But of course, we've been most focused on interest rates, and look at the 10-year. And so I think the minute we actually fear that the Fed is getting involved is when you're actually going to see yields fall, because people believe that if you remove all of the punch bowl here, you're actually going to see a lot of this go away and that it would actually lead to a flight to quality. So, I'm of the view that in the short to medium term, there really is an extraordinary environment. We had a 10% correction, maybe one of the quickest of all times in the NASDAQ, a 4.5% correction in the S&P, and I think we got a lot out of our way. I think there's a ton of liquidity. I don't think that the world is perfect. I think there's a lot of problems, and I think the market's expensive. But this is the same story we've had for the last 9 months.
Yeah. So it sounds like, Goldilocks for now, Dan. Goldilocks.
Yeah, it's interesting. I empathize with Guy's point about what central banks are doing. And really, I think the issue where he is grounded at is that every single one of these crises we have and every single policy response that we get is just furthering this income inequality gap that just is really going to be an existential threat to the globe at some point here. You know, we've seen populist movements politically over the last 5 years or so, and I think they're really grounded in some of what Guy's talking about. All that being said, talking about the stock market here and talking about the economy and the economic response to the worst health crisis and the worst recession that we've had in almost 100 years, they kind of did their job here. We're not in a depression. A year ago right now, I would have told you that we would have had structurally high employment. I did tell you that, above 10%, 11% or something like that. And here we are now, you know, at 6.5% or something like that. You mentioned the claims, and that was up from 3.5%, which was a 60-year low, I think, in January of 2020. So they did the job. We're not in a depression. Yes, there's a lot of people who are still feeling the adverse effects of this pandemic and the economic lockdowns from it, but risk assets don't seem to mind here too much. And so for all intents and purposes, they kind of did what they set out to do. At some point, though, throwing $5 trillion that's borrowed from the future just to keep this going is going to be the issue here. And that's why I fundamentally don't think rates are ever going to go meaningfully higher. We have to service all of this debt globally that we just keep piling on every crisis that we have.
It'll be difficult for rates to ever go higher because of all of the debt that we have. I get that sentiment. In the market context, Guy, is that actually good news, though? I mean, that seems really perverse and opposite, and good news is bad news, but I mean, that's actually a very good environment for stocks.
Yeah, no, listen, I understand. I mean, we talked about, I think, one of the nights this week, a rising rate environment historically is very good for stocks. And listen, maybe this thing continues just to do the grind, and you started with the best of times, right? I mean, but you have to wonder who is Sidney Carton and who is Charles Darnay in this equation for you literature fans out there. I encourage you to go to your Google machine. I happen to think that we're going to continue to go, and we're going to go to 2%. We're obviously not going to triple like we did from August to now, but I do think we have this move to 2% in the near to midterm. And I think by the summer, we're talking about 2% 10-year. And I think the market, specifically some of these high-flying, high-valuation NASDAQ names, are not going to like it. That's been the pillar of the broader market. And if that falls, you know, you got to look out and see what happens with S&P. That's my view. Now, I know that David Tepper spoke on Monday. He has a completely opposite view. He's smarter than I am. He's better looking than I am. And he's wealthier than I am. So you should probably listen to him. But this time, I just get a bad feeling that rates going higher are not going to be very positive for the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.